Well, another jobs insane surprise. It is a one day, of course, before the official BLS jobs report, but we have a private jobs report that likes to give us heads up, as well as unemployment claims and continuing claims and JOLTS numbers. We like all of this data so that we can try to understand what's going on in the economy. The JOLTS data coming out later today is expected to come in at 9.9 million, but what did we just get? We just got continuing claims. Continuing claims are a sign of how many people are unemployed, who are looking for work, and when the number goes down, it's a sign that they got a job, which is a sign the economy is still willing to absorb people who maybe lost their job and are now looking for a new job. We were expecting, survey says, 1.737 million continuing claims. We actually got 1.720, so a miss again on continuing claims. Not only did we miss on continuing claims, though, but last week we revised down the number by another 9,000. So in other words, strong jobs market. However, we did see initial jobless claims tick up a little bit to 248,000 versus the survey of 245,000, as reported just minutes ago. That 3,000 beat, though, was offset by a 3,000 reduction last week. So really, that's like 6 of one, half dozen of the other. No change there. I'll say initial jobless claims, basically no change. Continuing claims, a little bit lower. Great. But what did we just get with ADP? A blowout. An absolute blowout. So listen to this. We were expecting 225,000 jobs to be added in the month of June. What did we get? Look on screen now. It's a fat coupon code for the shadowing experience with Meet Kevin, link down below, or the courses. It's actually the ADP report. 497,000 change in private employment. Job creation surged in June. Oh no. Oh no. Oh no. This is my fear. Led by consumer-facing services. Oh no. That's your core. Remember Kevin's fear right now. Kevin's fear is that people are going to travel so much more than the seasonal adjustments are going to take into account. We're going to end up seeing core inflation rise, and people are going to lose their behinds, freaking out, thinking inflation is reanimating just because people are traveling more and spending more on leisure and hospitality. Anyway, leisure and hospitality, trade and transportation, education and health services showed strong gains. Still, the market was fragmented, with manufacturing, tech, and finance showing declines. Oops. Oh, dear Lord. Okay, so where are the numbers concentrated? Wow, that's actually very interesting. So it's the small businesses here, under 250 employees, that are adding like nutso. 160,000 for small. We just hired. First time ever, by the way. Never had this before. First time ever, just hired an in-house attorney. They're on, I don't know, like day like 8 or whatever. And it's so cool. Like, it's awesome. It's like, who do you want to sue? It doesn't cost you anything. I'm just kidding. That's not the intention, right? We have compliance purposes and stuff, but it is kind of cool. Anyway, so because ordinarily, like, if you, let's say you are to get sued, you're like, crap, I gotta hire an attorney and it's expensive and stuff. It's like, now it makes no difference. Anyway, 162,000 for small, 137,000 for 20 to 49 employees, 171,000 for 50 to 249. Small increase here for 250 to 499. How does that imply to large? Large, negative 8,000. Wow. This is actually really interesting. The big companies are not hiring as much. So consider that takeaway here for a moment. That's kind of incredible, actually. So what you have is you have companies, over 250 employees not adding. I'm going to say not adding because you have a slight plus here and a minus on the other. I think that offsets. So really over 250 employees, you're not adding. It's the under 250K adding like a nutso, which makes sense because that's going to be more of your restaurants, your hotels, and all your related hospitality services, your wave runner rentals, your skydiving rentals. Your oh man, it makes me want to go to the beach of Florida so badly. It's so warm and beautiful there. Anyway, I'm stuck in California. So what do we got in terms of specific sectors here? Manufacturing hit. You've got trade, transportation, utilities up 90,000. This is actually where we also saw some of that CPI heat. That was actually one of the biggest contributor of CPI pain over here. Then you've got, look at that, leisure and hospitality, 232,000. That one sector alone is bigger than the 232. Sorry, we were looking at 225,000. That's nuts. We were looking at 225,000. We literally beat that solely with leisure and hospitality. Some Broccoli Bob. Oh, that's an interesting name. It's an alliteration. Says, who do you want to sue? Nobody. Boxable. No, never. Anyway, so, okay, let's keep looking here. I want to see the wage data, though. So, wage data. So let's get the wage data. Mostly because when we look at the wage data, we can see how we're doing with any fears of a wage spiral, which we don't want. No, come on, where are the wage gains? Quite interesting. They're actually not indicated. Usually they're right at the bottom of this report. So I will continue to hunt for that. Anyway, let me see what Wall Street is saying for this and what this is going to do to our 5-year break-evens. It's probably going to drive yields higher. It's probably going to reiterate the hike, which in my opinion does mean you could have a potential sell down in stocks. But honestly, it's a good thing. It just says we're that much further away from a recession. Like anybody who says, oh, I got it. Anybody who says this is bad wants the economy to go into a recession or something. Doesn't make sense. This is absolutely fantastic. 5-year break-even just ticked up a little bit. So you're at 2.22, 0.1% on an uptick here. Not a big deal whatsoever. So that's okay. As far as, here we go. Okay, I'm getting the wage data now. As far as the, let's look at the Fed term rate expectations. That way we could see if the market's trying to price in any more rate hikes beyond what we already have priced. So the Fed term rate right now sits at a juicy and delicious, oh yeah. Okay, we just shot up from 5.35 to 5.41. So the way that works is you have to think that another 25 BP hike would put us at about 5.37. Anything above 5.37, which is the midpoint between 5.25 and 5.5, anything above 5.37 implies a second rate hike. So this means we are now starting to price in a second rate hike. This, honestly though, who cares? Like another 25 here, 25 there. I don't care. As long as we're not going into a recession, it just doesn't matter. You did just see another 3 percentage points added to the chance of a 25 BP hike for July. You're basically confirmed now, and you're still stable. No, you've added about 4% to the chance of a second hike in September. Yeah, okay, they shaved off the stay stable at 5. Okay, so now let's look at wages. So in the ADP report we have, here it is. Okay, we're going to compare this to the prior report because we want to see what's going on with wage gains. So this is very important. So we want to compare to the May report. ADP report for May last month. That was, let's see, there's the May release. That's the July release. Okay, well, let's just, for now, quickly compare to 2 months ago. We'll be able to see a little bit more transition if we go 2 months back. Okay, so I have both up here. So this here is now, and we're going to flip between the two. Ready for this? Job stayers, 6.4%. Go back 2 months. Job stayers, 6.7%. So continued decline. Job changers, you're at 11.2%. And you were at 13.2% 2 months ago. Okay, good. And what about leisure and hospitality? You were at 8.9%. Now you're at, oh, thank goodness, 7.9%. You want to see that keep going down. Other services, 6.3, was 6.5. Good. Education went down. Professional business services, 6.2. That went up. You actually had a little bit of a sticky push here. I don't want to see that. Wait. No, sorry. Hold on a sec. Did I do that right? No. It went down 1. Okay, good. It went down 1 basis point. I was flipped backwards there for a second. My bad. Okay, good. We want to see them all trend down. You've got financial activity stable, information at 6%. Yeah, that went down. That went down. Trade. Yep, all of them went down. Construction, 6.7 versus 6.9, 5.9 versus 6.2, 6.4 versus 6.8. Yeah, this is fantastic. So, yep, there it is. Pay gains slowed again in June. Slowest pace of growth since October of 2021. This is fantastic. I mean, it's great. Of course, the market is going to initially price in some concern because it means rates are going up, right? It means you have to start pricing in your next rate increase. But broadly, you have to look at it this way. We've priced in multiple more rate hikes from what we expected at the beginning of the year. We didn't think at the beginning of the year we were going to get to 5%. At least markets did. Then we got hot data in January. We got volatility in March because of that, along with the banking crisis. Even before the banking crisis in February, you had stocks sell down as we had to price in higher rates. So initially, when you get strong economic data, the first algorithmic response is crap, bad. That means more rate hikes. That means higher cost of capital. That means squeezing the economy more. That means J-Pow is basically coming up to you going, squeezing a little harder. Of course the market's going to turn red. That is the natural reaction of, yay, more rate hikes. But you have to remember, this is actually really good because it tells you the economy is that much further away from recession. The further away we are from recession, the better. Here's, what is this Logan commentary? Let's listen to this.
Because to give it a little more time, she's concerned whether inflation will return to target in a sustainable and timely way. She says the pace of labor market rebalancing remains slower than she expected and than forecasters expected. There's no indication, she said, of abrupt deterioration of the labor market. She's skeptical, and this is important. Logan comes to the Dallas Fed from having run the New York Fed monetary policy desk. So she was steeped in these issues of crises and financial crisis. First, no indication about large lagged effects from prior rate hikes. She says basically it's already in the market or in the economy right now, already had a fair amount of time to see the overall effects. Wow. She says housing markets looks to have bottomed and housing rebound could cause upside risk to inflation. The outlook for above target inflation, she says, and the strong labor market could calls for more restrictive monetary policy. And this is important. Tighter credit conditions, she's judged, are unlikely to offset the need for higher rates. And again, that issue we talked about, the rebuilding of the Treasury general account by $1 trillion, not created liquidity pressure, she says. So the three,
of course not,
have stayed the Fed's hand: lagged effects, tighter credit conditions, rebuilding the Treasury account. She's dismissing those as reasons
what about that
not
whole
to
story
stop.
You just told us?
She's not on board with that. She wants to see in the data. Like I told you, it was a story. It was something the data explains it. And I know we got a great guy who's going to talk about this stuff coming up, and I don't want to.
She makes some comment.
Yep, and that is Meet Kevin. So, bottom line, there's some questions here. Should we be concerned about this? Is it buy the dip? Obviously, your personal allocations, totally up to you, right? But my take is that the market that we're in is likely to see almost all dips bought by institutions. In fact, that's what we just talked about earlier on the channel, is that institutions are underallocated stocks. And so you're creating a floor that when you get dips, you get buying pressure because of either FOMO or an underallocation or the opportunity cost. Even though bond yields are high and they continue to rise, part of that is actually a cause of people dumping those bonds, driving yields up, and then allocating to stocks. So, but again, of course, the market's initial reaction has to be down because algorithmically, that's the way it works. If Fed rate hike bets go up, market go down. That's how it's worked for the last 18 months, and that's been the easiest trade ever. But consistently, what's happened over the last 6 months is that we don't care anymore about the rate hikes. What we actually care about is avoiding a recession and avoiding an earnings recession to the extent, or more than the extent that we've already priced in an earnings recession. You don't want a recession. These numbers today say no recession. They also say no wage price spiral. They are a red flag for the potential that core inflation ends up surprising up because of more than expected spending on leisure, hospitality, hotels, flights, and all that crap. But that will be temporary. That will be bad news between basically early August and mid-October. That's when you get your inflation reports for July through September. That's probably when you get your potential bad news. You get past that, now you get past the summer travel season, and if inflation continues to trend down, and there's no recession, or it's delayed substantially, it's all great news. Again, I'm not trying to like put on like rose-colored glasses here. I'm like, people are like, whoa, how could it be good news? We're not going into a recession. That is good news. Like, that's not rose-colored glasses. It's good news. You don't want to go into a recession. So, it's a good thing. This report absolutely does not point to a recession, which is fantastic. So I think it's great. Now, by the way, I want to just throw this in here really quick because I know some of you have been curious about this. MP Material emailed me a little angry yesterday because I tweeted about them. And so I wanted to address that and just put it out there. So yesterday, China talked about banning certain rare earth exports that are needed in chips to America. It's basically like a tit-for-tat slap back at America. And so I tweeted the following. How ironic. MP Materials jumping on Beijing restricting exports of rare earth metals. Yet 90% of MP Materials revenue comes from a Chinese company. So people are investing in the United States MP Materials thinking they're getting US rare earths, yet those rare earths are just going to China anyway. Okay? And then I tweeted this, which is the receipt, which is literally from their Q1 earnings report of this year. That's their words, not mine. As of March 31st, 2023, Sheng was the company's principal customer and accounted for more than 90% of product sales. So anyway, they emailed me and they're like, dude, come on, man. Like, that's phase one. And when we get to phase two, we're not going to sell 90% of our stuff to China anymore. And I'm like, cool. How about a factory tour or like a mine tour and an interview and we could talk about it? And they're like, yeah, we could do that after we transition to phase two. And I'm like, okay, cool. When are you guys transitioning? And they said, we're not ready yet. We'll let you know. I'm like, okay. So in other words, for the time being, you are going to still sell 90% of your stuff to China. And that's okay. But like, don't get mad at me for pointing it out. I think they're mad because I'm pointing out what is literally on their disclosures. Like, I'm reading their report. Like, don't get mad at me for that. It is what it is. But if you're going to say, like, hey, like, that's going to change when we get to phase two, fantastic. That's great. That is good news. But you're not there yet. So anyway, wanted to add that in. But again, bottom line, all this recession stuff, kick the can down the road. Recession is a good thing. Now, Goal here says, Kevin, I work for the largest trucking company that's going on strike. Does it rhyme with UPS? Anyway, the raises are huge. What we get, other trucking companies follow. Have to make a deal by Aug 1. Like, how huge are we talking here? Are we talking like 6%? Wait. Actually, are we talking trade, transportation, utilities? Are we talking 6.3%? Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by